Welcome to Clear to Close LLC. I'm your host, Steve Lachance with Integrity Mortgage, and I'm here again with Marty Norton. Marty, welcome back.
It was good to be here,
Great having you
Steve.
the last time, and we had some fun talking about a whole bunch of different things.
We did.
And we're going to do it again.
I am so excited to be here, and I want to thank you for inviting me.
Oh, it's my pleasure. I mean, we have some good conversations, and we find ourselves talking a lot about it. And like, wait a minute, we're supposed to be doing this recording so customers can hear this.
Exactly. It just flows well whenever we talk.
It's the passion. Yeah, you have the passion for it. So today we want to talk about self-employed borrowers.
Great.
And the follies, the difficult parts about getting a self-employed borrower approved, and why. I think the why is the big thing. Mm-hmm. So you had some questions before the show, and I thought one of them was really brilliant.
Well, thank you. Yeah, I did. I've worked with a couple of self-employed borrowers, buyers who are looking to get into a home very quickly before the end of the year. And one of the questions that I have, because I am really not sure, and that is, why do traditional banks, avoid offering a loan to a self-employed individual? And I was wondering if you could expound on that.
Well, and that's a great question. And the way you ask it, it almost sounds a little on the controversial side, because banks and lenders don't avoid self-employed borrowers. Well, perhaps some of the loan officers are a bit lazy or scared or intimidated by tax returns, because they can be overwhelming, especially with somebody with multiple businesses. So I've seen that in my career over the years, where loan officers are definitely shying away with it. This is going to be too hard. But for the most part, banks want to get these done. Lenders want to make these loans happen. They are more complex because, as with a W-2 borrower, where we can look at a pay stub and this is the income on the W-2s, there's no real related business expenses, although some W-2 borrowers do. But we do take that into account as well. But with a self-employed borrower, we have to look at the business as a whole with some time behind them to know that the business is actually being run successfully. Last thing you want to do as a lender, or even as a borrower, is get into something where you are declining dramatically. The business is clearly losing money, and then only to compound that problem by getting them into a home that they won't be able to afford in the future. So where do you go with that? That's
exactly. Yeah, one of the concerns that I would have when I send a self-employed individual to you, you're good at asking the tough questions with the borrower, but then after you take the mortgage and the self-employed person applies for the loan, where does that package go? Once it leaves your desk, does it go directly to an underwriter? Do you confer with other members of your management staff? Maybe you can talk a little bit about that.
Sure. So depending on where it's going to go, there are banks that will review all documentation. So they take that paperwork, 2 years tax returns, 2 years of business bank statements, or different types of documentation per bank, and they will analyze that income to look at not only just what did the business gross, but what were the expenses and what's the net result. But there are some things that aren't real losses where that lender can add that money back in, such as depletion or depreciation. So that's not a real income loss they have, but it's the asset depleting or depreciating. So the banks, in a lot of cases, have a committee that will review on a certain day of the week, where they take this deal and propose it, and everyone votes on it or something similar. In my world, it is a little less black and white, which is good. It's not one or two people making a decision. We have the collective software and underwriting from Fannie Mae and Freddie Mac. So we're going to take a self-employed income analysis, and with the net result of that income, enter it into an automated underwriting engine to help make a decision if the income is sufficient or not to make it work. So self-employed borrowers, really, it comes down to, you can't have it both ways. You can't not claim your income and yet at the same time want to claim the income when you're trying to get a loan. It used to be, in the day, you could. And we can talk perhaps on another show sometime about non-QM loans, which is becoming more popular. Non-QM simply means that it's not meeting agency guidelines. It's not meeting the Fannie Mae, Freddie Mac guidelines.
What is the QM?
It stands for qualified mortgage. So a qualified mortgage is defined by the CFPB, our regulators, that have worked with Fannie Mae and Freddie Mac to create the guidelines of lenders. That lenders use.
All right.
Now, if it fits outside of that box, a non-QM loan or a non-qualified mortgage, it's not being underwritten in the normal rules, there are some ways to still get those loans done, perhaps by using just bank statements. So we don't look at tax returns. We simply use 2 years of bank statements and look at business deposits and see if those deposits add up. And they won't use 100% of that because we know the business is going to have expenses. So we will look at maybe perhaps 50% of that in a non-QM loan. So again, probably a topic that we can get more granular on a different show. But there are still alternatives out there where for a while there was no such thing. This is not a subprime loan. So there's not going to be a bailout on those type of loans. So lenders that do non-QM have reserve requirements. No one's going to come to their rescue if those loans don't perform. So,
one of the challenges that I have when I first meet a self-employed individual, I don't drill down deeply into their expenses. I basically go with the things that I know.
Right.
And basically it's self-employed credit, their credit score, their income, do they have a down payment, and do they have any debts?
Right.
I don't drill down any further than that because I feel like I'm getting too deeply into their financial package. And that's why I explain to them if and when I refer them to you, that would be your job to take over.
Absolutely.
And I know your communication is good because you generally get back to me within a day or two and say, yes, we can run with this guy, or possibly not. So that's the challenge that I have. I'm not fully aware of the conversation and where it goes when I speak to a self-employed guy.
Yeah, and nor do you want to, because at the end of the day, even if you could calculate out the numbers and you're doing it correctly, it doesn't necessarily, it's going to meet that particular program or product's guidelines. There may be some additional restrictions that you're unaware of. And then, banks tend to be a little more conservative on a debt to income ratio, where some mortgage lenders that are selling directly to Fannie Mae or Freddie Mac or one of their correspondent lenders will have some more flexibility with those ratios. But all of that, again, is no different than I'm probably not equipped or suited to help them decide what a good offer price would be on that home, or what's it likely going to value at. That's simply not what I should be doing. That's where you come in for me as the expert.
Yeah, it relates to the actual property that we look at, the town that it's in, how far from their jobs, the quality of the construction of the house and things like that. So that's like a totally different animal when it comes to interviewing the self-employed. My thoughts about a self-employed individual is they need to be liquid. They should show liquidity from month to month to month. And when I ask them that question, and they say, we have plenty of money to do anything we want to do. And I don't get into down payments and things like that. But when I enter into an agreement with a buyer, there are some things that I need to talk about. And that is, do you have 3% or do you have 10% or 20% as a down payment? Because it would help you once they reach
because you're trying to get a vision of what direction should this go in and how you can coordinate them with the right lender. And when I'm talking to them, of course, one of the biggest things we're going to talk about is stability in that job as well, because I think that's where we lose track of what an underwriter is really trying to do. Why if I started a self-employed business and it's clearly making a lot of money, and the time frame is I've been doing it for 4 months. Okay, is it really making a lot of money? We don't know yet. I mean, the reality is what time frame is adequate. Now, I can tell you that the regulators would tell you 2 years is a minimum standard. We need to really look at a business for 2 years. There's some confusion about that with tax returns. I'll talk about that in a second. But with self-employed borrowers, we're really looking for, and frankly, all borrowers, even when you're W-2'd, we're looking for job stability. And that's not new, but it's really emphasized these days, where underwriters are saying, okay, we know you're making good money right now, but the last 2 years are really not averaging it out to where you are today. So I got a raise. Okay, but we're not going to stop there. We're going to have to look at, if you're hourly, where have your hours been over those last 2 years? Is it normal that they're giving you 80 hours right now? Or is it, have you been averaging more like 40, 39, or 42, or maybe some overtime? So we got to look at the trends. Is it always going to be there? If we're using that maximum amount of income to qualify, how does it average out? Self-employed is not going to be any different. We're still going to look at how does that business trend year over year. And then there's some gaps. So you have 2 years taxes from the previous years, and now we haven't got into the next tax season yet. So what did the last year look like? For all we know, there's been no income in a year. How do you prove that? We got to see those tax returns. We will ask for a profit and loss statement, but I always chuckle when they're not audited. So a profit and loss statement can be anything. I can't call somebody a liar. We look at it, and is it consistent with last year's? Yeah, okay. For a while during COVID, we were asking, per the regulators, for 3 months of business bank statements to see, are those deposits recently there? Are they consistent with the P&L and with the previous tax returns? That has since been lifted, which a relief from a lot of folks. I would not be surprised in different economies to see that condition come back. But for right now, profit and loss statement for last year, previous 2 years tax returns. I mentioned a little something about taxes that we can avoid where you've seen less than 1 year taxes. If you have a borrower, if one of your borrowers is self-employed and they've been doing it at least 5 years or more, and I can have a CPA letter or an accountant confirm that they have indeed been doing that business for that amount of time, quite often when I run their loan scenario through my underwriting engines, Fannie Mae or Freddie Mac may only ask me for the last most recent filed tax return. It has to be the correct one. In other words, we're in 2022 where we have not hit the filing time yet. So I wouldn't need 2021 taxes, but I would need 2020s.
Okay.
So I can't say, well, here's 2019 and I didn't file 20. No, it's got to be the most recent that you would have had to file. And look at that. If that 1 year average looks okay and they've been in business for a long time, we can often get away with that. So that's, I wouldn't call it a trick to the trade, but it is a finding that I'll get from Fannie Mae or Freddie Mac that it may allow me to do a limited amount of documentation, which is helpful. If 2019 wasn't that great, but 2020 was okay, it got better, then you have a very good shot at just using that 1 year tax return, which could help the numbers. Could also make it worse, because if 2019 was better, 2020 was lower, in that case, we may want to do the average.
And on some occasions, I'll be talking with a self-employed carpenter. Carpenters seem to be, plentiful that approach us. This carpenter may be a W-2 employee and then moonlights in the evenings and weekends.
Sure,
and
very common.
And some limited self-employed people are hungry. They're looking for the extra business, and they're establishing themselves in the entire state. This guy could be driving to Brewer on a Saturday and Sunday to finish a job.
Right.
So that's a good case scenario.
Yeah.
Because the guy's hungry.
Yeah.
Or the girl. It doesn't really matter. I have self-employed women as well that I work with. But when a self-employed individual approaches you and says, yeah, I'm a W-2 employee, but I'm also, moonlighting on the side, all cash, but I have that cash as my down payment. Walk me through that scenario where they've had a good job for like 10 years, W-2, but their real down payment is coming from, their moonlighting.
Sure, yeah. So when it comes to the a self-employed borrower, we're still looking at the same normal bank statements they have, either business or personal. It's not uncommon for a Schedule C sole proprietor to have commingled funds into just a regular savings account or checking. And that's not a problem per se. Where the income, where the cash being used for down payment is important if it's their money. So if it's in their bank account, it's been coming from sources that I can legitimately prove. So it's okay, even if we're not using the income for it.
Okay, so you need to prove that source.
Correct. Yep.
And and I know that the source is from the weekend warrior type
and that's
work.
Okay. And it's none of my business really. If I have 2 months of bank statements and a borrower's had those funds in their account for at least that amount of time, where they got it prior to that is not my concern. Okay. With some exceptions, of course, if we have to look at previous bank statements. But we are looking at large deposits. So if you suddenly had a one big job you did and you plow that money right into the account, if I can show that, yes, you do this little side job, this is obviously within your line of work, and it was a a check from a vendor or something, we may have to ask a few more questions, but yeah, we can do that. But you will find that some self-employed will start to clam up at that point. They are like, oh, well, we don't want to talk about that because it's cash under the table. They're not claiming that income, and don't do that. But they do it. And that said, it gets a little sticky, but we're not here to question their tax methods for that particular purpose.
But that will not, for lack of a better word, kill the deal at that point. You can still work with the self-employed individual. You just have to, you have to be transparent, obviously, to a point. And,
we have to follow laws like the anti-money laundering law to make sure that we've verified, do we really know where this money came from?
Exactly.
Is it that? Was it some ill-gotten gains that were put into it? Or was it somehow the loan officer's doing a little side deal over here? Don't look over here. We'll give you the cash. You put it in your account. Now we've somehow laundered it. I'm kind of a nerd. I don't know if that's really money laundering or not. But basically, sourcing of where funds come from is important. But if you have a bank statement that has $15,000 in it, and I look at it, if your average balance has been $15,000 for the last 6 months, it doesn't matter where you got it. The FBI, the banks, they all know they've done their homework. They know where it's coming from. So that part I'm not concerned about. So
let's talk about the actual mortgage payment. Let's talk about how you arrive at an interest rate. Once you've done all the documentation, once you have sent the package to your underwriter and you're in the discussion phase, at what point do you set the interest rate and decide and determine whether it's 3% down, 10% down, et cetera?
So just like any borrower, if you're self-employed, we are going to analyze your home affordability based on a number of factors: credit, what your income numbers work out to be. We calculate both a housing and a debt-to-income ratio. There is a difference. So we do have two ratios we look at, and if they meet those requirements, we then talk about what do you have for available assets? What could you put for a down payment? And we try to fit them into a program that seems to be where I drive most of it, is what they have for available assets. Because the answer gets real easy if you say, I've got $5,000 and I'm buying a $200,000 home. I think we only have a couple of options there. So it's going to be a limited down payment program, but someone wants to put maybe 5, 10, 15% and they have those assets, they're likely going to have more than one option, which means that we have some deciding to do. Which is really where your expertise come into play as well, because in this market, I can have borrowers that are qualified for rural development, FHA, VA, conventional, some of the variations of conventional, and you're going to put in an offer and you're going to say, Steve, this is great. I'm glad they're approved for this program. I don't want to pick on any particular product, but I'm up against 15 other offers, or even 5, whatever it is. Can we get this into a conventional? That's the most oftenly asked question right now from buyer agents is, can you somehow get them into a conventional? And maybe that's the option. But at that point, we now have to look at what would that rate be on that deal with that conventional loan at that time with their credit scores and all that factored in. So that number is going to change throughout the process, meaning you start looking today and it takes you 3 months to find something. That rate may not be the same. Could be higher or lower, depending on the market.
What I've found is when I start working with buyers, and it's usually a couple, and if one of them is self-employed, over a period of maybe 2 or 3 meetings with them, they share a lot of their financial information with me. And when we start looking at houses that they like, and they said, well, we can put down $20,000, or we can pay up to $90,000. That's what I have. I mean, they tell me more information than maybe they should. And I always inform my buyers, tell me less. I don't want to know the highest amount that you would go in this house. Because I don't want to conflict with my negotiating skills. My job with a buyer is to get the property for the least amount of money. But if somebody says, we love the house, we want it, we're all in, how much can you put down for an appraisal gap? And they'll say, we can go up to $30,000. And I said, okay, well, that's good to know. Thank you. let's continue to talk about
Yeah,
this.
and you and I have talked about that, and you know how I feel about those in the past shows. But I don't want to go down that rabbit hole because I get pretty passionate about that one. But you're absolutely right. That's just the way things are right now, and that's how it works. Is you don't want to get too much information so that you're not rowing in the right direction for them. And I'm on the opposite side where I need to know everything, because the devil's in the details on my side of it.
Exactly.
An underwriter think of it as forensics. They are going to dig deep, and that's their job.
You have to.
And it's not just to protect the bank. That's 99% of it. But really, it's to make sure that we are following the compliance and doing it the way the government has set this up.
Right, because 3-4 weeks into a transaction, I don't want to get that phone call from you. No. And I don't want to have to say to you, somebody has just lost their job, or, the documentation is not correct. Yeah. So it is, the devil is in the details. Yep. But, one of the nice things about this session today is I'm learning more and more things when I first interview a buyer. Yeah. A self-employed buyer, I'll be able to ask them a little bit more specific questions. Yeah. Not to do your job, but to work in conjunction, almost as a team approach.
Well, you set the stage, so that's what makes it so helpful. When you're asking certain questions, it's no different than I'm starting to talk to somebody about a home. You send a buyer my way, and I'm talking to them about where do you want to purchase, and they really want to just tell me all the towns. And for me, it's general questions. It doesn't matter whether it's Madawaska or Sanford, Maine. It's all fine for me. Yeah. But the reason I ask is to get a bead on what the property taxes might be in that area. It's not my job to choose a location or help them find where they want, but making sure I may understand the numbers, and then but things like that. It's no different. So we set the stage of knowing their expectations and then making sure we understand fully their situation. So by you asking a borrower some basic questions about their employment and how the structure of it, we can have an intelligent conversation about our client, and then be giving the same incorrect information to our client at the same time. I think that's critical. And there's I've actually sat with agents that have actually done the math, and done the formula, and they look at the calculators online, and they've said, this is the payment you'll be paying, and here's what you should be expecting for an interest rate. And wow, be careful of that, because I have a hard time, 25 years of doing this, and I have a hard time sometimes looking at that going, okay, it on the outside looks great, but here's the interpretation. This is going to happen when you look at the documentation with underwriting. So when you think you know what somebody makes for income, even borrowers that know what they make, unless they're flat salary, it's very differently viewed, because you start looking at averages over time.
I very rarely make a statement about mortgages and what they're going to be paying per month. I very, very rarely do that. I will ask them, how much do you think you can afford? Right. And because I know the house.
You want to know their comfort zone.
Yeah, I know the house. And, if it's a $300,000 house, then I have a ballpark figure in terms of what I think the monthly mortgage payment would be based on the town, the taxes, and everything else. But I don't go down that road, and because I don't want to get into trouble. Right. And I don't really quote rates or anything like that. No. That's smart. I had
someone doing that. I had a loan officer doing this. No, I didn't, but I listened to a loan officer once, and he was saying, oh, you should be going in at this house. This is the price you should really be offering on that. Like, whoa. Yeah. Don't do that. What you should be doing is call Marty. Marty, these guys need some help on determining what they should be putting in for an offer. Yeah. That's always my default. How much do you think we should offer, Steve? Yeah. I don't know. I can tell you right now, swing hard if you're going to go into it.
Well, I usually ask. I'm a pretty good judge of people when we're looking at houses, and if I see the excitement in their eyes, I know they're all in on the property. Yeah. But I also know realistically how much they can truly afford, and if a house is $300, and I think you need $350 or $360 to get it, and that's out of their comfort zone. We'll have that conversation right there and then. Yeah, yeah.
But no one wants to get three-quarters of the way into this and find out.
And I've had many buyers who have said to me, "Hey, we're all in on this house. We're going to go up to X number of dollars. How do you feel about that?" And I said, "I think that's a good offer. And if I don't think it's a good offer in this market, I'll be honest with them. Yeah. and I'll say, 350 is good, but I think to get it to be realistically, you should go up to 365.
Yeah.
Or 370.
I think I see too much of that going on where we're crossing the lines on giving advice, and just too many times I see loan officers giving real estate advice and real estate agents giving loan officer advice. I think the best advice would be let's get your loan officer on the phone, or let's get your realtor on the phone, or that's my favorite one. Is I'll always say, that's a terrific question. Probably better suited for Marty to answer that. Yeah. You're asking about value and what you should be offering, because I'll tell people, you got to go in and swing hard, and if you're not going above asking price, I could be all wet on that. I'm not negotiating that transaction. For all I know, the seller's already told you, we'll take any offer you can bring us. I don't know what the case is, so I don't want to influence folks to make decisions to overpay for something. That's not a good plan. So defer back to you on that one.
There are some challenges on every property, and if I see 2 or 3 problems in a property, standing water in the basement, a furnace with all kinds of corrosion throughout, I'll point that out. I'm not going to make the decision for them, but I definitely point it out to them that this could be a challenge.
It's the teamwork too, because what I love when I talk to your buyers, I'll say something like, Marty said that. 2 minutes later, I'll say something, Marty told us that. And then 5 minutes later, that's what Marty covered. I'm like, Marty's got this under control, so we're in good shape on that. Yeah. But that's what is awesome to hear, because we're rowing in the same direction. We're telling people the same thing. They're not getting conflicting information that's throwing them way off balance and giving them doubt about what's going on. Yeah. So if you don't, some borrowers are working with lenders that are out of state, or they're a call center somewhere in the country. They don't have that mix going on with their realtors. So they're not necessarily being well represented in that case. So,
absolutely.
Good. I love working with you.
Oh, thank you, Steve.
It's just
good partnership.
So much smoother. I appreciate it. You want to stick around? I want to do another show with you.
Absolutely.
I want to talk to you more. We have some other topics we want to cover.
I would love to do that.
Yeah,
Steve.
thanks.
Just want to put a plug in for Marty Norton, Keller Williams Realty. And don't forget, I'm a member of the Marc Gup Real Estate Group. Right down the road. And my number is 207-408-6861. Thanks.
We'll put some graphics up on the screen for you guys. Don't forget to like and follow if you like this show. And if you have any stuff you'd like us to talk about, always put a comment down in the comment section. I love reading them, and I will help you out with it. Thanks again.